I'm going to put this at your request. We're going to record this, and just a little background and introduction. Mark is the CEO and CIO of Morgan Creek Capital Management, based out of North Carolina. Founder, CEO at Morgan Creek. He's also managing partner of Morgan Creek Digital Assets. Morgan Creek Capital Management was founded in 2004. Currently manages close to $2 billion in discretionary and non-discretionary assets. Prior to founding Morgan Creek, Mr. Yusko was a CIO and founder of UNC Management Company, the Endowment Investment Office for the University of North Carolina at Chapel Hill. Before that, he was Senior Investment Director for the University of Notre Dame Investment Office. Mr. Yusko has been at the forefront of institutional investing throughout his career, an early investor in alternative asset classes at Notre Dame. He brought the endowment model of investing to UNC, which contributed to significant performance gains for the endowment. The endowment model is the cornerstone philosophy of Morgan Creek, as it is the mandate to invest in innovation. Mr. Yusko is again at the forefront of investing through Morgan Creek Digital Assets, which was formed in 2018. Morgan Creek Digital is an early stage investor in blockchain technology, digital currency, and digital assets through the firm's venture capital and digital asset index fund. So Mr. Yusko, thank you so much for being here, and we really appreciate your time. It's really an honor to have you. And so I'll pass it on to you, and we really look forward to this. And for all that are in the audience, please feel free to submit any questions as they come to mind. We'll try and get to them at the end of the presentation. Thanks.
Awesome. Thanks, Roy. And thanks everybody for being here. And do send questions in the Q&A panel. I do something called speed sliding. So you don't need to see everything on the slide. Some of them are only going to be up for a few seconds. I'm going to go through a lot of slides, and I'll point you to kind of where I want you to look. Apologize for the suiting up, but I actually did a CNBC hit earlier today, launching our SPAC ETF tomorrow, SPXZ. And I decided, hey, I hadn't put on a suit in 9 months, literally 9 months. So I figured I'd keep it on while I talk to you guys. So we're going to talk about this institutionalization of blockchain and crypto, or as I like to talk about it, hashtag #GetOffZero. So on the left-hand side, you see all the big fancy words about blockchain and crypto, but on the right-hand side is really what this is all about. There is a digital divide happening, and that is going to drive the adoption of this digital landscape in the future. You ask anyone over 35, who's your broker? UBS, Merrill Lynch, whatever. How much gold do you have? I don't know, 3, 4, 5%. How much Bitcoin do you have? Oh, are you kidding me? That's a scam. It's a Ponzi, 0. Ask anyone under 35, who's your broker? What's a broker? I mean, I got a Robinhood account. You mean that? Okay, how much gold do you have? Oh, are you kidding me? Pet rock, 0. How much Bitcoin do you have? I don't want to talk about it. Why not? Well, it's a really big percentage of my net worth. So that digital divide is real, and it's going to become even bigger. So this idea that a plan conceived in moderation must fail when circumstances are set in extremes, it's as applicable today as it was, 1,000 years ago, that, plans are created in times where there's no stress. And when there's stress or extreme situations, like I believe we're in the markets today with QE infinity, then they start to break down. And we always overestimate the change that will occur in the next 2 years and underestimate the change that will occur in the next 10. Don't let yourself be fooled into inaction. Now, Andy Grove wrote this book called Only the Paranoid Survive, and he talked about the idea that an inflection point is an event that changes the way we think and act. And there are few skills as powerful as understanding when things change. Now, there are lots of different types of inflection points. I said, I'm going to go through slides fast. You can have the slides to look at them later. But the big one we're going to talk about now is exogenous shock. And when there's an exogenous shock to the system, it creates second order or third order effects that make current trends accelerate. So the global pandemic is an example. So if you think about the normal way of viewing inflection points, it's basically what happens is you're going along and this inflection point occurs and you have to decide, am I going to jump on this wave of innovation? And if you do, right? You can ride it up through the next big thing into the mainstream. If you pick the wrong horse, like picking Betamax instead of VHS, bad things happen. Now, what's really interesting is it's not a single point, it's a strategic response to innovation around you. So you're managing your business, you're doing your company, and Andy Grove said it best, right? If you're wrong, you die. But most companies don't die because they're wrong. Most die because they don't commit. They fritter away valuable resources while attempting to make a decision. The greatest danger is standing still. So think about ABC, NBC, CBS, and Netflix, right? ABC, NBC, CBS used to have all the content. They had all the eyeballs. They had all the market cap. Today, it's all gone to Netflix. Netflix has all the market cap. Why? Because ABC, NBC, CBS wouldn't change. They wouldn't recognize that subscription services was a thing. They didn't want to give up their ad-based revenue model. Now, it's not just one big decision. It's a series of big decisions. So every business grows along an S curve, right? Formative phase, sustained growth, slowdown, saturation. On the left-hand side, the reality is it's not just one S curve, it's a series of S curves. And if you don't manage the transition, the phase shift from one to the other, you die. So death is a bad outcome. Now, innovation and disruption are what drive these long cycle revolutions. And these long cycle revolutions in technology have been occurring for millennia or in centuries in terms of the digital age. So in the 1700s, when the Republic was formed, it was about transferring muscle power, right, into machine power. So there was this transportation and energy revolution. And then it became, in the 60s, this idea of a digital revolution or electronic revolution, the age of information and telecommunications. And so these epochs on the right-hand side occur over time, and we're about to enter the sixth epoch. Now, what's that sixth epoch all about? Well, it's all about blockchain. So the information age evolved into the digital age, and that sets up this cognitive revolution. But that cognitive revolution is driven by computing power. So one of the most important slides in the whole deck is the left-hand side, which, when my dad was the real Mr. Yusko, every time someone says Mr. Yusko, I'm looking around for my dad. But the mainframe computers that he sold back in the 1950s were built by companies, IBM, DEC, and my favorite, Wang. In 1954, they innovated. So they took computing power from governments to business. 14 years later, and it's always 14 years, which I don't really know why, but we'll figure that out. So 14 years later, this microchip innovation came along. And if you invested in companies like Fairchild and Intel, you made a ton of money. 14 years later, the personal computer comes along. I grew up in Seattle. Most of my friends don't work anymore. They were smart enough to go to work for Bill and his band of crazies. If you've ever seen the picture of the original Microsoft 7, you might forgive me. They were a little rough looking, although we were all rough looking in the 70s. But I didn't go to work there. Steve Ballmer's mom said, honey, why would you go to work there? No one would ever want a computer in their house. He has 18 billion reasons why he was right, mom was wrong. And so, interestingly, 14 years later, we innovated again, and we had the internet. Now, the internet, there's that great clip of Bryant Gumbel and Katie Kirk saying, what is internet? What is that @ symbol? Well, the internet was a big deal. And we invested in these little companies, one called Yahoo, one called Google, stupid names at the time. Our board thought we were idiots. We put $500,000 when I was at Notre Dame in this company called Google, turned into $200 million. There should be a quad at Notre Dame called the Google Quad. Now, we didn't do that directly. Sequoia did, but we invested in Sequoia. Now, the internet was big, really big, but even bigger than the internet was the mobile net. 14 years later, in 2010, suddenly we all had these handheld supercomputers, billions of them around the world, all connected. And I was back in Seattle at Craig McCaw's house for a venture capital event. And I asked Craig's family office guy, do you think the mobile net is going to be as big as the internet? He says, Mark, are you kidding me? Ask people if they want a PC. They're like, yeah, whatever. They ask me if I want a mobile phone. Well, I already got two. I probably don't need another one. So it's going to be bigger. And so now 2024, which is still 3 years from now, is the trust net or the blockchain era. So this, I believe, is simply an evolution of computing's power. And it has to do with connected devices on the left-hand side. In the 1950s, there were no connected devices. By 1996, there were a few connected devices, the DARPA net. And then ultimately, in 2024, we'll have hundreds of billions of connected devices in the Internet of everything. Now, the adoption of technology occurs on a common path. The thing is, it happens faster. So the flush toilet took a long time for everybody to have one. Here in North Carolina, there's still homes, believe it or not, that don't. Now, the crazy thing is things like social media go almost immediate, and everybody's got social media. So these trends happen much, much faster, and that has implications. So let's think about how trends occur. So back in 2000, internet usage, 2001, hit 50% of the population. And suddenly, we were all going to do everything on the internet. Now, the big failure, in fact, the poster child for failure of the tech bubble is this company, pets.com. Now, let's think about this. On the right-hand side, $20 billion market cap company, chewy.com, it's the same damn company. It's the exact same thing. It's just we needed a maturation. We needed multiple inflection points for that innovation to work. We needed home broadband to hit 50%, not just the internet, because dial-up modems didn't work, right? Netflix was a horrible business when it started, right? They sent discs and discs got lost or they broke. Then they tried to do video on demand. The problem is it took 4 days to download a video. No one's going to wait 4 days to download a video. Now it happens in a matter of seconds. So that's what streaming's all about. Now, if you think of the most valuable companies in the world, they're actually not companies. They're networks. Apple is a network. Amazon is a network. What does Amazon make? They don't make anything, right? They just match buyers and sellers. They're a network. And the more users, the more nodes in a network, the more valuable the company. Bitcoin is a network. It is one of the most valuable networks on the planet because it has so many users. Now, why are networks important? Well, in the old hierarchical world in which we lived, companies on the left-hand side, they controlled assets. You were a great company if you had property, plant, and equipment. You had lots of hard assets. Today, it's about intangibles. It's about network. It's about customers. It's about having relationships. And why is that important? On the right-hand side, costs increase linearly. Value accretes exponentially to networks. And that's because of the way exponential math works. In fact, humans are not really good at math, right? If I ask you 2 times 2, 4. Okay. If I ask you 17 times 23, I'll wait, right? That's the limit of human intelligence. The average person can't do that without a calculator. If I ask you, how are you at nonlinear logarithmic regression? You're going to say, probably not very good. So the difference is the most valuable companies are taking advantage of this exponential growth in value and a linear increase in cost. And the math behind networks is so elegant. Whether it's Sarnoff's law, Metcalfe's law, which is my favorite, which says the value of the network increases proportional to the square of the number of users of the network. And remember how square works. It's like that old Breck commercial. You tell 2 friends and they tell 2 friends and so on and so on and so on. Pretty soon it's off the screen. In fact, here's an example. If I take 30 linear steps across my office, I get across my office. If I take 30 linear exponential steps, I go around the world twice. People say, it's BS. Do it. It's math. And Reed's law says that networks grow proportionally to the size, but they scale faster at the edge. So influencers can make networks grow even faster. Now, if you want to invest in inflection points, that means you have to back transformational technology. And right in the middle of this honeycomb is digital assets. Digital assets are one of the most transformational technologies we will see in our lifetime. Why? Because welcome to the digital age. Digital disruption is impacting every incumbent. The largest transportation company in the world owns no cars. The largest hospitality company in the world owns no hotel rooms. Every business, according to this survey, right, 40% of incumbents over the next 5 years, every business will be impacted by digitization. And the digital age ushers in massive, and I can't underscore that term enough, massive opportunities for profit for those who embrace the digital world and who invest in the digital world. And the common characteristics of blockchain, look, it's just a ledger. And we've had ledgers for thousands of years. We used to have clay tablets, and then we had papyrus, and then we had the dual entry ledger pad that the Medici stole from the monks, and we've used that with the banks for the last couple hundred years. And now we have a triple entry accounting ledger, which is blockchain, and it will literally change the world because we no longer need a trusted third party. We no longer have to worry about people changing the ledger, right? In the old days, if you had a single entry ledger and I lent you $100, but I wrote down that you owe me $2, how could you prove different? It says you owe me $2. Well, then we had dual entry. So we both wrote down, but people could still change that. And the big thing about distributed technology is encryption. So crypto kind of has a bad rap. It's kind of like this, oh, that's dicey. No, all it means is cryptographically secure and most importantly, trustless. And all of this will improve liquidity, lower cost, increase efficiency, and give us better security. Here's an example. Anyone ever had to get a new Visa number? Yeah, all of us, right? Why? Because Visa gets attacked 30,000 times a day. They don't get, broken into 30,000 times a day, but they get attacked 30,000 times a day. And sometimes they lose data and people have to get new numbers. Well, here's the thing. In computing, you can be secure or fast, not both. It's like in investing. You can get richer or wiser, never both. So in computing, you can choose. You can be Visa. You can be very fast, but you're not very secure. You can be the Bitcoin blockchain, the Bitcoin network, the Bitcoin supercomputer, which by the way is the most powerful supercomputer on an order of magnitude of 1,500x, not 1,500%, 1,500x times more powerful than the CERN supercomputer. Hundreds of millions of transactions, not one fraudulent transaction in 11 years, not one. It is the most secure network on the planet. Very important. What blockchain does is it enables a single source of truth. It's why I dubbed this term the trust net. The trust net, I think, will be christened around 2024 when we all realize that everything we do will come back to blockchains and every industry in which we interact. This whole voting ridiculousness we've just lived through, none of it. We don't need any of it. Every person, one vote on a blockchain, public, secure. We could solve all the problems. Now, people don't want us to solve all the problems for lots of different reasons, but insurance, healthcare, food delivery. Imagine having contaminated food in your Walmart. Do you recall all the food? Or how about just recalling the food from the farm where the contamination was? That would be better. Knowing the provenance of food through blockchain will save lots and lots of money. Or legal contracts. Are human beings better at contracts or code? I'll trust the code every single day. If you get lost, do you stop and ask directions or do you look at Google? We trust code. Now, the blockchain era, I'll make a big statement, will usher in a period of unprecedented wealth creation, will be the largest wealth creator we will see in our lifetimes. Big statement. Why? Because we're decentralizing trust and we will allow value to flow over internet protocol. This is the key. Value over internet protocol is the greatest innovation of this century, bar none. Now, it's not new, right? It started in 1988. This guy, Tim May, wrote it all down, 2 pages, called the Crypto Anarchist Manifesto. God rest his soul. He passed away last year. Now, for 20 years, no one cared because it turns out if you're an anarchist and you live up in the hills with your guns by yourself, you don't influence anybody. So eventually Satoshi-san, whoever he, she, they are, came along and invented Bitcoin. And the haters immediately started. Jamie Dimon, it's a fraud. Now his firm 2 weeks ago, put out a 400-page report saying it's going to $146,000, but he still thinks it's a fraud. Warren Buffett famously said, it's rat poison squared. And his partner, right, Charlie, said, no, it's worse than that. It's like trading newly harvested dead baby brains. WTF, Charlie? Seriously? Now, here's the thing. Charlie Munger might have spent 10 minutes thinking about crypto, Bitcoin, maybe 10 minutes. Well, Charlie Noyes, right, has spent 10,000 hours talking about crypto and Bitcoin. Well, who's Charlie Noyes? Charlie Noyes was a partner at Pantera, and now he's a partner with another firm in Silicon Valley. When he was 11 years old, he started coding. When he was 14, 9 years old, started coding. 11 years old, started mining Bitcoin. At 14, he won the national competition for his paper on distributed ledger technology. 16, full ride to MIT. At 17, he said, hey, this is too easy. Can I just take a test? Dean said no. He dropped out, went to work at Pantera, then went to work for Paradigm. So I'm going to trust that Charlie more than Charlie Munger when it comes to this. So blockchain will revolutionize financial services. What the internet did to commerce and information exchange. Think of email, right? In the old days, some of you are probably old enough to remember letters, right? You put them in an envelope, you put a stamp on it, you send a letter. So I'd send a letter to my girlfriend. She'd think about it, right? Day, go by, she sent it back. 7 days would go by for that communication. I always joke, my wife can't wait 7 seconds for a response to a text. So 7 days. Now, what if I wanted to send multiple letters to multiple girlfriends? Well, then I had to find a Xerox machine and a bunch of dimes and a bunch of letters and a bunch of envelopes and send them out. Well, what if I wanted to say something different to all the different girls? Well, then I had to literally cut and paste and put different letters together, send them out. Today, with email, I can send 1 million letters with one push of a button. And if I want to send different letters to everybody, cutting and pasting is much easier through technology. So if you think about media, what happened to the media companies, like with Netflix versus the big media companies? Think about Amazon roadkill in e-commerce. All of that is coming for financial services through blockchain. WEF started today. Last year, they said that this blockchain will be the beating heart of the new financial system. Well, why do we need a new financial system? The old one works okay. Does it? Look, banks have been under attack for decades. You don't actually borrow money from a bank anymore. You go online and get your mortgage. You go online and do a peer-to-peer loan. There are tons of businesses, fintech companies that are beating up the banks. So do we really need banks in the digital age? And remember, 40% of the adults in the world don't have a bank account, but they have mobile phones. We can deliver financial services, the equivalent of financial services, bank services, to the world's population using blockchain technology and crypto. No banks. Unbelievable. Now, blockchain also enables the transition to the digital age of securities. So think about the Buttonwood tree in New York, where the stock exchange is. In the old days, we had analog. I'd take an analog piece of paper, and you would have an analog stock certificate, and we would meet under the Buttonwood tree, and we would exchange. Then we realized that's kind of dangerous because we could get robbed on the way, or it might rain. So let's put it inside, and let's put all the paper in Dallas at a place called DTCC. And then let's have these electronic QSIPs that you and I will trade in our brokerage accounts. It's not bad. It's kind of expensive, and it's really concentrated in the Western world. But how about if we had a digital ownership of every asset? And that digital ownership is truly global. It's fractionally divisible, meaning I can own a little teeny tiny piece. Imagine digitizing the stock of Apple, right? You don't have to buy one share of Apple. You could buy any amount of shares of Apple using blockchain technology. Tokenization of every asset, whether it be stocks, bonds, currencies, commodity, real estate, art, every asset in the world will be digitized. Every stock, every bond, every currency, every commodity, every piece of art, every piece of real estate, all of it. Why? Because 14 trillion with a T transaction transfers every year. 700 trillion. Remember, 1 trillion is $1 a second for 31,710 years. Trillion's a big number. $700 trillion of assets will be digitized and will all transact over blockchain technology. So I do these 10 surprises. I'm doing our 10 surprises for this year on Thursday this year. A year ago, my bonus surprise was that Bitcoin prices would probably rise, maybe a lot in 2020. Now, I didn't think they'd be up 300%, but my point was I wasn't sure if it was Bitcoin going up or fiat going down. When you're a republic that's massively in debt, you only have 4 choices. You can pay the debt back, you can restructure it, you can default on it, or you can devalue it away. Well, we can't pay it back, no chance. We can't restructure it because that means someone would have to take the deal. We can't default on it because then the politicians get kicked out. So what are they going to do? They're going to devalue it. So we knew that the dollar would go down and that real hard money would go up. So anytime a country transitioned to fiat currency, they collapsed. That's what we did in 1973. That's just world history. You don't have to know about cryptocurrency to know that from Nipsey Hussle. Again, God rest his soul. If you don't believe it or don't get it, I don't have time to try to convince you. Sorry, from Satoshi Nakamoto. Again, whoever he, she, they are. Bitcoin's remarkable cryptographic achievement, the ability to create something which is not duplicable in the digital world, has enormous value. Lots of people will build businesses on top of that. That's from Eric Schmidt. He knows a thing or two about the world. I see Bitcoin as ultimately being a reserve currency for banks, playing much the same role as gold did in the early days of banking. Banks could issue digital cash with greater anonymity and lighter weight, more efficient transaction. Hal Finney, again, God rest his soul, maybe one of the original 4 who was Satoshi Nakamoto, possible. Just makes sense to get some in case it catches on. If enough people think the same way, that becomes a self-fulfilling prophecy from Satoshi. Probably a good idea. Now, the history of money, of commodity money, is pretty solid, pun intended. Fiat currency, not so much. Every fiat currency in the history of the world has gone away. Every single one over time. Now, the oldest fiat today is the pound sterling. And 371 years ago, a pound note bought you a pound of sterling silver. Today, it would take 174 pounds of silver to get a pound note. Okay, it's a little devaluation. Now, everybody says, oh, but there's nothing backing Bitcoin. Really? You mean like other currency? What's behind a dollar? Nothing. No tax revenues, no gold, no silver. The only thing that backs currency is custom. That's all that backs currency. You can exchange it with someone else and get value for services. That's it. That's what makes currency. Now, the economists predicted in 1988, around Tim May, that we would have a global currency. And they called it the Phoenix, and they said it would happen in 2018. Not too far off. It took 20 years for Satoshi-san, whoever he, she, they are, to come along and create Bitcoin. And 10 years later, it was going to be the future of money. Now, the funny thing about this is why the gold coin? There's no gold and there's no coins. It's like calling Madoff a hedge fund problem. There was no hedge and there was no fund, right? The guy hadn't made a trade in 11 years and he just stole people's money. Now, this is the most important slide in the whole chart, in the whole deck. So on the right-hand side, gold, that little gold line, gold's been money for 5,000 years. 1 ounce for 5,000 years has bought a fine man's suit. From Cleopatra's time to the American Revolution to today. Go to Savile Row, give him an ounce of gold, you get a fine man's suit. Maybe like the one I have on. So, which I haven't had on for 9 months. In 1973, Nixon took us off the gold standard and created the fiat fiasco. And fiat now is on a long, slow road to the bottom, to the right. And cryptocurrency will ascend to be the reserve currency for everything. But on the left, it's a scam. It's a bubble. See, I told you when it went from 100 to 10, it was a scam. Oh, then it went to 1,000. Well, but then it crashed down to 100. Well, then it went to 3,000. Well, then it crashed to 600. Well, then it went to 10,000. And it crashed. Well, guess what? Every one of those crashes and bubbles is inside the line on the right. You just can't see it if you zoom out. If you zoom out and don't pay attention to the daily price, it's a big deal. Because the Lindy effect says the longer something survives, the longer it will survive. So we will become a reliable store of value. We will become a widespread medium of exchange. It's just a matter of time. It's about capability versus potential. Think about LeBron James when he was 10 years old. How much would you have paid for his future earnings? Now, if you see LeBron at 10, you say, well, maybe not so much. He looked like a normal kid. He's not a normal kid. Investing in crypto and Bitcoin today is like investing in Yahoo or Google in 1996. It's going to work out. Now, I can make the case that networks grow along parabolic curves, left-hand side. I can make the case that we are halfway through the frenzy phase of the S-curve adoption, and we're a long way from synergy or a mature market. I can easily make that case. I can also make the case that based on nonlinear regression, okay, this model was built in 2014. It predicted that Bitcoin would hit $10,000 of value in 2017. It was off by 6 days. And it says by the middle of this year, it'll be at 100,000, probably hit there. I could also make the case that based on scarcity, it is the scarcest asset in the world today since the last halving. And that as it moves in this stair-step pattern because of stock to flow. What is stock to flow? It means the new flow of an asset relative to its existing stock is very low. So your stock to flow ratio is very high. And if you think about it, the best assets, the best stores of value have a great installed base relative to the new flow. So whether it's real estate or gold or diamonds or silver, and Bitcoin has progressively moved to be scarcer and more scarce because of the halving events. We reduce the number of block rewards every 4 years. So I've been talking about stock to flow on places like CNBC. Turns out Druckenmiller, I like being in the company of living legends. So he was talking about it later that day. The CIO of BlackRock says it will replace gold as the primary store of value. You know, what do they know? They manage $8 trillion. But the media narrative, crypto's sinking, and like rats fleeing a sinking ship, bankers are leaving en masse for crypto. That's the reality. I believe in two things: follow the money, follow the talent. Only twice in my life have I seen the migration of talent that we are seeing today. And that was in 1996 when people were going to the internet. So we are early. So today, at $1 trillion of value in crypto, right? That's smaller than the FANGs, which, you know, Apple's 1.6 trillion. I mean, Apple's 2 trillion, Amazon's 1.6 trillion. I'm going to guess that the next global world reserve currency is probably going to be worth more than Apple and Amazon. Now, if it hits gold's market cap of 8.2 trillion, it's worth 400 to 500,000 per coin. If it hits global money, it's a big number. The institutions are coming. They're afraid of things like, you know, exchanges and custody, but people like us and others are developing products that make it available for institutions. Now, wait, Bitcoin was the best performing asset again for the 11th year in 2020. Way better than stocks, way better than gold, way better than bonds. Why? Because it is the perfect store of value relative to currency. Like if you look at stocks, over the last 3 years, it looks like stocks are up almost 10% a year compounded, but they're not. That's because you denominate in dollars. If you denominate in gold, you're down 15%. If you denominate in Bitcoin, you're down more than that. So it's all about the reference currency in which you think value. The best performing stock market in the world the last 3 years, Venezuela. Did you want to own Venezuelan stocks? I didn't think so. So money illusion. Assets appear strong only if you value them in dollars. If you value them in real money, in Bitcoin, they're all declining in value. Now, Bitcoin, biggest winner in the election. So we talked about it was looking like it was going to break out right before the election. It has, you know, hit as high as $40,000. Look, we believe it will be $100,000 this year. It could even go higher than that on speculative fever. But the value of the network will reach $100,000 this year. Now, look, the chart on the left is kind of cool. It is the projected price of Bitcoin based on central bank balance sheets and the actual price of Bitcoin. I'm not a statistician, but that's a really pretty good correlation for the first 10 years. The central banks have kind of lost it. Now, have they lost it enough that we create the Weimar Republic? I don't think so, actually. But this is telling us that Bitcoin's going up a lot. Now, the bull market hasn't even gotten started. The bull's just sharpening his horns. If you look at the red arrows, which are the previous halving events, within 180 days of the halving, as we go from red dots, which means the halving just occurred, to yellow dots, meaning 180 days later, you see big bull markets. We're just getting started in the upper right. And we've got another, 100 and something days before we get to the peak. So sometime this fall, late this fall, we're likely to see the cyclical peak. Could it be, people like Max Kaiser think it'll be at 220,000. I'm a little more conservative. I think it'll be somewhere in the hundreds. Look, Bitcoin today is roughly equivalent to the other FANG stocks. Gold is next. But if it grows at the rate that it has grown in its history, it's grown $10 every day in the 11 years it's been alive. It's pretty good. If it were to reach the US money supply, it's 100x. Now, if it could 100x over 8 years, wouldn't you want to own a little? The asymmetry of the upside downside is extraordinary. Now look, way more people getting long than getting short. Being short Bitcoin is almost as bad as being short GameStop. Big one today. So institutionalization is real. PayPal and Cash App, right? PayPal this quarter, for the first time, will have revenue from its Bitcoin business. It's going to be a good quarter for PayPal. Cash App has, really added a lot of value. They are buying more than 100% of the daily minted coins. And Michael Saylor on the right took $1.2 billion, $500 million from his corporate treasury, and another 600 plus billion from a convertible bond that he issued. I love this. He issued a convertible bond and invested it in Bitcoin. The guy's a genius, mad genius. So the normalization of traditional finance, really important. We have futures, we have options. The longer and stronger the markets get, the more innovation, the more traditional areas of overlap, the better. And it just means that, open interest is going to rise and more users, institutionalization. Guggenheim amended their documents so they could buy, GBTC in their $5 billion macro hedge fund. And GBTC is buying 10x the number of Bitcoins mined every day. And their growth has been unbelievably phenomenal at Grayscale. So the institutionalization is here. Now, the smart money shorts, the detractors say, but the smart money is short. They just don't understand. All that is an arbitrage. What people do is the smart money, the big money, they buy the private shares of GBTC, where you have to be an accredited investor. They hold for 6 months. They short Bitcoin against that. So they remove the price risk. And then they sell to the retail investors at a 20% premium 6 months later, make 20% guaranteed over 6 months. That's a nice IRR. Some of them are even doing it on leverage. So again, if you dig deeper into the data, you get the real story. Now, in 2017, there was FOMO. What if searches on the right-hand side went parabolic like they did in 2017? My guess is summer and fall this year, they will, and we will see a parabolic rise in Bitcoin. And when the bull market really gets going, the monthly returns, 50, 60, 70, 100% in a month. Now, we actually saw that in November and December, and then it gave some back. My guess is those big months are coming again. Long-term trend, 5% a month. What's really interesting is the right-hand side. The long-term trend, the 10-year trend of the price, the current price is below by almost 50%. So just to get back to the long-term trend, we have a lot of upside in addition to the increase in fundamentals. Now, this is one of my favorite charts. CZ from Binance said, that thing on the left in 2013 was a parabolic move. That was a 20x move. It looks like a bump. It looks like a speed bump. And the second speed bump in 2017, which was an 11x move in 12 months, will eventually look the same. And you can see on the right, a month later, sure enough, it's getting smaller and smaller. We're flattening the curve. The landscape is changing, and you can choose to ignore or you can embrace. Now, we know one thing. When you add an uncorrelated asset to a portfolio, your return goes up and your risk goes down. Markowitz won the Nobel Prize for that. I have a t-shirt that says Markowitz was right. And look, I got white hair to prove it. I've been around for every alternative asset that has promised low correlation, and none of them deliver. Bonds, 30% correlated. International stocks, 60% correlated. Hedge funds, 50% correlated. Value and growth, 75% correlated. Bitcoin is 0.15, 15% correlated to stocks and bonds. Why? Because the primary drivers of crypto are different than the primary drivers of stocks and bonds. The reason stocks and bonds are correlated is because they depend on corporate profits, economic growth, interest rates, and things like productivity. Crypto, none of that matters. It's about millennial usage, that digital divide, investor adoption, network growth, Metcalfe's law, regulatory and technological development. That's what drives crypto. So you think you're diversified? How about this? 5 years ago, if you had taken 1%, 0.5% from stocks, 0.5% from bonds, put it in Bitcoin, instead of making 7.2% compound for the last 5 years, you would have made 9.2. It's pretty good. Now, the cool part is, had it gone to zero, which 5 years ago, there was still some chance of that. I'll argue pretty close to zero, but some chance. You still would have made 7%. So a 10-to-1 upside downside ratio. From here, where I think there's zero probability of a zero outcome, your upside downside, your asymmetry is awesome. If you added 3%, right, you increased your return by 40% and your risk only went up 20%. So your Sharpe ratio more than doubled. Went up 60%. If you added 5%, not 50 or 60, 5%, you doubled your return and your risk went up 20%. So your Sharpe ratio more than doubled. So look, we need to rethink our strategy of hoping Bitcoin will go away. It's $1 trillion market cap, across all crypto. Bitcoin's about 700 billion. It's time to get off zero. Couple ways to do it: picks and shovels. So we run funds that invest in the infrastructure around crypto currencies and blockchain. And then we also have two products, an index fund and a Bitcoin risk managed fund that helps you do that. So with that, I'm happy to look at the questions. Talk about regulation, Yellen, etc. Look, ignore the FUD. So ignore the fear, uncertainty, and doubt. Incumbents will always rail against new technology. So Yellen and Lagarde will tell you that this is used for drug dealers. Think about it. If you're a drug dealer, would you rather use a sack o' money or put your fingers on a keyboard? All day, you're going to use a sack o' money. In fact, Katie Hahn, who's the partner at Andreessen, said it best. She said, look, I was a prosecutor for 20 years. I went after bad guys. And given the choice between a sack o' money and fingers on a keyboard, I'll take fingers on a keyboard every day because I can find those guys. So ignore the FUD. They're going to try to tell you that it's bad. China tried to ban it in 2017. And what happened? The exchanges just moved to South Korea and Japan. Yellen and Mnuchin want to say they're going to regulate it. All that's going to happen is U.S. will be less of a power than we already are. And China's going to be first. China will have the first digital global currency, which is different than a cryptocurrency. A digital currency is a fiat-backed currency. It just works digitally, can go on a wallet. China will have one. Russia will have one. We'll eventually get one because we'll have to. But cryptocurrencies are different. They're truly decentralized. They cannot be shut down by governments. They can't be regulated away. How does one address the issue of lost passwords? Okay, that's great. So one guy, $225 million bucks. Think about this, right? How much money has been lost over the years from maybe not lost passwords, but lost safety deposit box keys? People die without leaving a will that tells them where the money actually is. Satoshi talked about this in his white paper, which is amazing, right? 11-page white paper. And he actually talked about, consider the lost coins a donation to the community. And so, yes, there will be examples of people who try to do it themselves. And that's why people like us exist, right? We have a professional team that does custody and security. I mean, look, there are personal security issues of owning a bearer asset, right? If someone knows you have Bitcoin, will they kidnap you and torture you to give them the password? I don't mean to be gross, but that's a real risk. So there is benefit to having a centralized custodian like a Zappo or a Coinbase or Gemini. So all of these institutions will build up. And that's one of the reasons we invest in infrastructure. One of our investments, BlockFi, Blockchain Financial, don't call them a bank, but they're basically a bank where you can hold your assets. And everybody says, oh, but then you lose your keys. That's exactly what I want to do. I want them to control the asset, because then if they lose it, I have insurance. Oh, Russell, great to see you. I saw you earlier. I'd love to catch up. Bitcoin versus Ether. Man, it's a tough one. The way in 2015, first quarter, I wrote one paragraph on why I thought Bitcoin was a great investment, special situation. I also wrote one paragraph, the next paragraph, on why I thought Saudi equities were a great special situation. Now, these were in a 41-page letter, 2 paragraphs. I had people call me the next day and say they would fire me because I was talking about magic internet money. Now, arguably, Saudi equities are probably more controversial than Bitcoin, but no one cared about Saudi equities. They just cared that Bitcoin was magic internet money. Now, I was at $500. It was a pretty good recommendation. Now, here's the funny thing. I joke, and it's less funny now after the Khashoggi thing, but crypto is like Saudi Arabia. There's the king, there's the crown prince, and all the other princes that hate each other, right? There's 6,000 princes supposedly in Saudi. They all own some oil wells and they all hate each other because, you know, they'd like to be the richest one. So what I think is interesting there is Bitcoin is the king. Ethereum is the crown prince, and then there's all the other princes that hate each other. And there's only a dozen cryptocurrencies. The rest are utility tokens. They're just crowdsourced venture capital. Most of those will go to zero, and that's okay. If you're a techie and you can look into the technology of some of those, you might make 100-baggers, but a lot of them are going to go to zero. But again, that's okay if you have a portfolio of them. So the way to think about it, Russell, is this. The internet was created. There were 80 protocols. 5 exist today. TCP/IP, HTTP, SMTP, FTP, and www dot. Okay, www dot is like the glue that keeps all the protocols humming. I think Bitcoin will be the base layer protocol. There'll be other protocols on top of it, whether it's Polkadot or Cosmos or whatever. And Ethereum will be like the www dot of the Internet of Value. It's what will drive everything, and all of the applications will be built. So to say which one's going to do better this year, no idea. To say they'll both do well, yes. Ethereum's already done really nicely this year. It's up like 40%. But look, Ethereum is going to be very, very, very valuable for different reasons than Bitcoin, but they'll both do great. What happened to the 51% attack? This is great. Again, the genius of whoever he, she, they are to design something that totally negates its biggest threat. So the threat that's being referred to here is if the miners, the people, and mining is a horrible term because there's no digging, there's no machinery. You basically are taking computing power. So think of it as a data center. In a data center, you have a room like I'm sitting in, you fill it up with computers, you plug in the computers, and then you go find customers, Amazon or Azure, to buy your computing power. That's a data center business. Well, in crypto mining, you buy machines, different machines, GPUs and ASICs instead of CPUs, and you then plug in the power, and then you sell to an algorithm. So you don't have to find customers because the algorithm will take all the power it can get to secure the network. So it is perfectly secure. And so you have this wonderful business. Well, the way it works is if I want to send a Bitcoin to Russell, the network says, 1, Mark has a Bitcoin. 2, Mark sent it to Russell. And 3, Russell has it. And 51% or more have to give a thumbs up every one of those 3 steps. Now, what this question is about, well, what if a bunch of people colluded, like China has a bunch of mining power, and they said, no, we're going to say that Mark gave that Bitcoin to us in China. Here's the thing. As soon as there was a 51% attack and a transaction got busted, what would happen to the value? It would go to zero. So there's absolutely no incentive to ever do a 51% attack because all the stuff you stole would be immediately worthless. Again, it's mind-blowingly genius. All right, good deal. So I'll be in touch, Russell. But Roy, back to you. Probably overstayed my welcome.
No, absolutely not. What an incredible presentation. Thank you so much for your presence and making this private markets technology web conference so much better. So obviously, I'll be happy to connect any of the LPs that join us for this conference with you directly, and look forward to staying in touch and following those predictions. All right. Thank you so much,
Thanks.
Mark.
Really appreciate it.
Absolutely.
You're in a great group. Thanks for having me. And cheers to your event tomorrow.
Perfect. Thanks so much.
Take care.
So that'll be, that's the end of our first day of the conference and the Private Markets Technology web meeting. Thank you for joining today. Tomorrow's a virtual networking session. We'll send an email regarding how to access the Zoom for tomorrow's second part of the conference. Thank you all for being here, and we'll look forward to hosting you tomorrow again.
This is number one champion sound.
Take me on a trip, I'd like to go someday. Take me to New York, I'd love to see LA. I really want to come kick it with you. You'll be my American boy. Take me on a trip, I'd like to go someday. Take me to New York, I'd love to see LA. I really want to come kick it with you. You'll be my American boy.
Yeah, Estelle, we about to get down. Yeah, Estelle, we about to get down.
You'll be my American boy, American Would you be my lover? Would you be mine? Would you be my lover? Would you be mine? Would you be my lover? Would you be my American boy? American boy. Take me on a trip, I'd like to go someday. Take me to Chicago, San Francisco Bay. I really want to come kick it with you. You'll be my American boy.
Okay, guys, take care. Have a great day. Don't forget to invest in Bitcoin.